Hello guys. As promised, I will be making a video discussions of the summary of the last video that I let you watch. And then also I will be explaining to you what will be the effect to the accounting values supposing those items or those adjustments are not made in the book. And then I will be also giving you an illustrative problem. Okay, and also, in addition, I am also adding here correction of errors. Okay, so let me start. So as a summary, there are three items that required adjustment in the books at the end of the accounting period. You have accruals, deferrals, and provisions for doubtful accounts and depreciation. Let's start with accruals. There are two types of accrual. You have accrued income and accrued expense. So let's start with accrued income. So what is an accrued income? An accrued income is an income already earned but are not yet collected. An accrued income is an asset account. To adjust, you need to recognize the receivable and the income. Okay, so this is your pro forma entry. So to recognize income or accrued income, you debit accrued income and credit income. Okay, accrued income, or you can also use the account title receivable. So for example, you have an accrued interest income. You may also use interest receivable. Okay, so they mean the same thing. So accrued income or accrued interest income, or rather interest receivable. Okay, so either credit, accrued interest income, or interest receivable and credit income. Okay, now what will happen, or what would be the effect in your book supposing an accrued income is not recognized or is not recorded? Okay, so take note, the accounts affected for accrued income is asset and income or revenue. Okay, so what will happen to your asset supposing you cannot recognize or you were not able to recognize accrued income? Your asset will be understated. Then no effect on liability, since I said the account involved is only asset and revenue or income. Then we'll go this first before we will have the equity. So since you cannot recognize income, then your income or revenue will be understated, and then no effect or expense. And then what will happen to your net income? So supposing revenue is understated and then you have the correct amount for expense, then your net income also will be understated. And then you will be closing your net income to equity. So if your net income is understated, then also your revenue, rather your equity, will be understated. Okay, so those are the effect for accrued income. The next will have accrued expense. Expense already incurred but are not yet paid. So for example, you receive utility bill and then or bills, no, and then you decided to pay the next week. No, supposing this is the end of the month, the end of the accounting period, and then you receive a bill and then you will pay it next week. So this bill should be recognized as an accrued expense. So these are expense or expenses already incurred but are not yet paid. So accrued expense is a liability account. To adjust, you need to recognize the expense and the liability. And this is the pro forma entry to recognize accrued expense. So it's a debit to expense and a credit to accrued expense. For example, it's utility or utilities, no? You debit utilities expense and then you credit accrued utilities expense, or you may also say accrued for instead of saying accrued utilities expense, you may have utilities payable. Okay, so you may use utilities payable. So accrued, utilities expense, or utilities payable. Then what will happen to your, or what is the effect to your accounting value supposing you were not able to recognize accrued expense? So take note, the accounts involved are expense and liability. So liability is an expense. Okay, so if you cannot recognize liability, your liability will be understated. And then your expense, so your equity, no effect to asset, your liabilities will be understated. Then let's skip equity. Let's proceed to revenue. No effect to revenue. And then expense will be understated. So what will happen to your net income? The revenue is correct. Expenses will be understated. The effect would be overstated net income. And then you will be closing your net income to your equity. So if net income is overstated, your equity also will be overstated. Okay, so those are accruals. We'll now proceed to deferrals. For deferrals, there are two items. We have prepaid expenses that's related to expenses, no prepayment of expenses. And this one is related to income, pre-collection of income. For deferrals, prepaid expense, we have, okay, when you recognize prepaid expense in your book, you may recognize it as an asset method, the whole thing, the whole payment, or the whole prepayment, or you may recognize it expense, no, the time you make the payment. Then for pre-collection or pre-collected income, there are also two methods on how to recognize pre-collection. You have the income method. It means that you will be recognizing the entire collection as income, while the liability method, you will be recognizing it as a liability. So let's start with prepaid expense asset method. Okay, so in this account or in this method, you will be using an asset account um, when you made or the company made the prepayment. So asset account was originally debited upon payment. So when you are to make the adjustment, you need to adjust the expense portion. Okay, so asset account, adjust for the expense. Okay, so this is the pro forma entry. So during the time you made or the company made the payment, this was the entry made. It's a debit to prepaid expense, an asset account, and a credit to cash. Okay, so this, since it's asset method, it was debited to an asset account. And then at the end of the period, since you are recognizing it as an asset, what you will recognize at the end of the period is the expense. Because what happened is that at the end of the period, this prepaid expense will become a mixed account. So meaning a portion of it is part of, rather, a portion of it is asset and a portion of it, the expired portion, is an expense. So since asset ka at the start, you need to recognize expense at the end of the period and reduce the prepaid expense. Okay. Now, what will happen if you were not able to adjust your prepaid expense and then you are using the asset method? So take note, we are talking about prepaid expense. So the accounts affected are assets and expense. Okay, so take note, asset method. So what will happen to your asset if you were not able to prepare the adjusting entry? Your asset will be overstated since you were not able to recognize the expense portion. And then what will happen to your liability? No effect. Okay, so we'll proceed directly to revenue. No effect. Then expense. What will happen to your expense? Since asset ka at the start and then you were not able to recognize your expense portion, then your expense will be understated. And then what happened to your net income? Revenue is the correct amount, and then you have an understated expense. It would follow that your net income will be overstated. And then since income is overstated and you will be closing it to your equity also will be overstated. Okay. Then next, still have prepaid expense, but this time expense method was used to recognize the prepayment. So pasabot, an expense account was originally debited upon payment. Okay, so at the end of the period, you need to adjust the asset portion. So this is the pro forma entry. At the time of payment, this is the journal entry made. It was debited to an expense account, then credited to cash. So at the end of the period, you need to recognize the asset portion. Since expense ka at the start, you recognize the asset portion or the unexpired portion, and then reduce your expense. Okay, so again, recognize, since it's an expense account originally, then you have to recognize the prepaid expense and you reduce expense. Now, what will happen supposing you are not able to prepare the adjusting entry and then you are using the expense method? Again, the accounts affected, if you're talking about prepaid expense, is asset and expense. So what will happen to your asset? Since you are using expense method and then no adjustment for the asset portion, then your asset will be understated. No effect to liability. Derechota revenue, no effect. Expense, okay, since expense method ka and no adjustment was made, so your expense will be overstated. Then what happened to your net income? You have the correct amount of revenue, but your expense is overstated, so your net income will be understated. Okay, so you are to close your net income to your equity. So if you are closing an understated income, your equity also will be understated. Okay, we'll proceed next to deferrals. So we have first method, pre-collected income method. Okay, so in here, what happened is that the time you receive the cash, you recognize it in full as income. Okay, so since you recognize it as an income, then you need to adjust the liability portion at the end of the accounting period. Okay, so this was the entry made upon receipt of cash, okay, or upon collection, no? So it's a debit to cash and a credit to income. Okay, so you recognize it as income in the whole amount. So at the end of the period, you will be adjusting the unearned income or the liability portion. So what happened is that reduce the income because you are having income at the start in full amount. So at the end of the period, you need to reduce your income by the amount representing the unearned portion. So you debit income, then you recognize the liability, the unearned portion. So credit unearned income. Okay. Now, what will happen if you were not able to recognize income, or rather adjust your pre-collection, and then your income, you are using income method. So take note, the account affected here, or the accounts affected, will be liability and revenue. Okay. So you are using income method. So meaning the full amount was recognized as income or revenue. So what will happen? Your asset will have no effect. Your liability, okay, so income method ka, you're supposed to recognize the liability portion, but you were not able to do it. So your liability will be understated. Okay, so let's skip equity. Let's proceed directly to revenue. So revenue will be, since income method ka, your revenue will be overstated. Then no effect to expense. And then what happened to your net income? You have an overstated revenue, then with the correct amount of expense, still your net income will be overstated. Okay, so close your overstated income to your equity. So in effect, your equity also will be overstated. Okay, so that's income method. Then we have pre-collected income liability method. So what happened here is that when you receive the cash, the pre-collection was credited to a liability account. So at the end of the period, you need to adjust the income portion. Okay, so this is what happened upon receipt of payment from the customer, no, or the yeah, the customer, the client, you debit cash, and then you credit unearned income, which is a liability account. Okay, so this is the original entry. Then at the end of the period, since you are using an earned income account, you will be recognizing the income portion. So what will happen is that you need to reduce the liability. That's why you debit unearned income and recognize income. Okay, so again, debit unearned income, then credit income. So what will be the effect to your accounting value supposing you were not able to prepare the adjusting entry? Okay, so take note again, the accounts affected will be liability and revenue. So to asset, there is no effect. Liability, overstated. Why overstated? Because again, originally you recognize it as a liability, the whole amount. So if you were not able to adjust, then it's overstated. And then that is your revenue. What will happen to your revenue? You recognize it in full as a liability, and then there's no adjustment made for revenue, so your revenue will be understated. Then no effect to expense. Then you have net income. So what happened to your net income? So supposing you have an understated revenue and then the correct amount of expense, so your net income will be understated. Then close your this understated net income to your equity. So your equity will also be understated. Okay, so these are your pre-collections. Okay, then we have provisions for doubtful accounts and depreciation expense. So what are doubtful accounts expense? Doubtful accounts expense is a portion of the accounts receivable doubtful as to collection. Doubtful accounts expense is an expense account. Okay, so this is your pro forma entry. Upon recognition of your doubtful accounts expense, is a debit to doubtful accounts expense and a credit to allowance for doubtful accounts. The allowance for doubtful accounts is a contra asset account. Your accounts receivable should be presented in the balance sheet at net realizable value. So to compute for the net realizable value, it's accounts receivable gross minus the allowance for doubtful accounts. That's net realizable value. Okay. Now, what will happen if the company were not able to recognize doubtful accounts? So take note, the accounts affected for doubtful accounts will be asset, your and your expense. Okay. So what will happen to your asset? Your asset will be overstated since the doubtful accounts will increase the allowance for doubtful accounts, and then allowance for doubtful accounts will be deducted from your asset accounts or accounts receivable. So if you were not able to recognize doubtful accounts expense, then your asset will be overstated. And then no effect to liability. Then we'll go to revenue first. So revenue will have no effect. And then expense will be understated because doubtful accounts is an expense account. So if you cannot recognize doubtful accounts, your expense will be understated. So your net income will be overstated. Why? Because you will be deducting your expense account from your revenue. So if it's understated, your net income will be overstated. And then close it to your equity. So your equity account will be also understated. Next, we have depreciation expense. This is a portion of the cost of a tangible asset recognized as expense during the period. Depreciation expense is an expense account. Okay, so um, I said this is related to intangible assets. So for example of a tangible asset is building. So when you purchase a building, it doesn't mean that the entire cost of that building will be charged against the revenue during the period. Okay, so you will be charging the cost of the building over its estimated useful life. Okay, so every year you will be recognizing the depreciation expense. For example, it's a 1 million building, and then you assume that the useful life of the building is 10 years, then every year you will be charging to depreciation expense 100,000. Okay, so when you recognize the depreciation expense, this is the journal entry, it's a debit to depreciation expense and a credit to accumulated depreciation. Accumulated depreciation is also a contra asset account because this will be deducted from the cost of your building, for example. No, so from the cost of your building, because your building or your tangible asset will be presented in the book at book value or carrying amount. Okay, so cost of the asset minus accumulated depreciation is equal to book value. Now, what will happen if you were not able to recognize depreciation expense? So remember, depreciation, the related accumulated depreciation will be deducted from your assets. So if you were not able to recognize depreciation expense, your allowance rather for your accumulated depreciation will be understated. So your asset will be overstated. And then no effect on liability. And then revenue, no effect. And then expense, since depreciation is an expense account, then expense will be understated. And effect to your net income, revenue is okay, while expense is understated. So it would make your net income overstated. And then close your net income to your equity, and overstated income will also overstate the equity. Okay, so that's a wrap up of what you watch no in that video. And after that, I will be giving you an illustration on how to prepare adjusting entry. Okay, so this is a trial balance and data for adjustments of Kisada's laundry and dry clean business for its fiscal year ending September 30, 2018 are presented below. So this is a trial balance and adjusted, and these are the data for adjustments. Okay, so let's start with number one. An analysis of the insurance policy showed that 3,400 is still unexpired. Okay, so this is a prepayment. So what you will do is to check on the unadjusted trial balance because you need to determine the method used when the prepayment was made. Okay, so try to check the existing account title. So the existing account title is prepaid insurance. This is an asset account. So it means that an asset method was used when the insurance premium was paid. Okay, and then it is stated there that 3,400 is still unexpired. So this is the 3,400 is the asset portion. So what you will do is deduct the 3,400 from the 17,000 so that you will know how much is the expired portion. Okay, so this is the adjusting entry. Since asset method was used when the insurance premium was paid, so to adjust, they will be recognizing the expense portion. The payment was 17,000 as shown here. It's 17,000, and then the unexpired portion is 3,400. To 17,000 minus 3,400, the insurance expense that should be recognized is 13,600. So entry is debit insurance expense and reduce your prepaid insurance, credit prepaid insurance, 13,600. So what will happen is that after this entry, you will be having na the insurance expense of 13,600, the expired portion, and you will be reducing your prepaid insurance to 3,400 by crediting prepaid insurance of 13,600. Okay, so that's the adjusting entry for number one. For number two, an inventory of cleaning supplies amounted to 6,220 on hand. So it means that these are the unused portion of the cleaning supplies. 6,220. So again, check the existing account in your unadjusted trial balance to determine the account title or the method used to record the purchase of cleaning supplies. So it's you have there cleaning supplies. So it's understood that the company is using the asset method. So since it's asset method, you will be recognizing the expense portion. So cleaning supplies 36,870 deduct 6,220. So how much? Okay. The expense portion is 30,650. So what you will do, recognize the used portion or the expense portion since you are using or the company is using the asset method. So the entry should debit cleaning supplies used 30,650. How did we compute 30,650? It's 36,870, the unadjusted amount, minus the 6,220 unused cleaning supplies. So you have again cleaning supplies use of 30,650. So your adjusting entry is debit or recognize cleaning supplies use 30,650 and then reduce the cleaning supplies. So credit cleaning supplies 30,650. Next, number 3. 10,000 of accounts receivable may prove uncollectible. So there is no existing data for allowance for doubtful accounts. So this is automatically the amount you'll recognize as doubtful accounts. Okay, so the entry to number 3 or for number 3 is debit doubtful accounts expense 10,000 and credit allowance for doubtful accounts 10,000. Okay, and then next annual depreciation is 43,000 on the building and 20,000 on the delivery truck. So you already have the existing account title. So whatever is the existing ones will be the one are the ones that we are going to use in preparing the journal entry. So for number 4, we debit depreciation expense, a total of 64,000. Then we credit accumulated depreciation building 43,000 and accumulated depreciation delivery truck 21,000. Then number 5, accrued interest on the mortgage payable is 5,000. Okay, so we have already an account here, interest expense. So that's the one that we're going to use. And the amount is given, so there's no need for us to compute how much to accrue. So our entry for number 5 is a debit to interest expense 5,000 and credit accrued interest expense 5,000. Number 6. On August 1, 2018, the company signed a contract effectively immediately with the hospital to dry clean for a fixed monthly charge of 2,000. The doctor's uniforms during surgery. The hospital paid for 4 months service in advance. Okay, so what is this? This is a pre-collection. Okay, so if you're going to check your unadjusted trial balance, we have an earned dry cleaning revenues of 8,000. So we'll check. This is an advance payment, good for 4 months. Okay, and then the payment or rather the collection was made August 1, 2018, and our accounting period will end September 30, 2018. So if you're going to count August, September. So from August to September 30, one half of the unearned dry cleaning revenues are already earned. Okay, so it's 2 months it's 2 months and then per month is 2,000. So 2 months times 2,000, the portion earned is 4,000. Okay, so one half actually. Okay, this is good for 4 months. So what should be our journal entry? Okay, so since it's recognized as a liability during the time it was collected, so what you will do is you will be recognizing the revenue portion, which is good for 4 months. So what you will do is reduce the unearned or the liability account. So debit unearned dry cleaning revenues 4,000 and then recognize revenue, credit dry cleaning revenue 4,000. Next, we have number 7, unrecorded plant wages, total 10,000. So what should be our entry for this one? The amount is given, so we have no problem. So we'll just check the account title used related to plant wages. So we have plant wages expense. Okay, so our entry is debit to plant wages expense 10,000, then credit plant wages payable or accrued plant wages expense 10,000. You may either use this one or this one. What is important is that you should be consistent with the account title you are going to use. Okay, so that's number 7. The number 8, sales and delivery wages are paid on Saturdays. The weekly payroll is 4,800. Then September 30 falls on Monday and the company has 6 day per week, pay per week. Okay, so how will you compute for the accrued salaries and delivery wages? The 4,800 is good for 6 days. So 4,800 divided by 6 days. So payroll per day is 4,800, rather for per week is 4,800. So per day that's 800. Okay, and then it's stated that September 30 falls on Monday. Actually, there is only one day that has to be recognized, no? That is September 30 only because if that is Monday, then the next payday falls on the Saturday. That would be October already. Okay, so for the month of September, we only accrue salaries and delivery wages good for one day lang for September 30. Okay, so our journal entry or adjusting entry for number 8 will be, so check on the existing account title. So we have salaries and delivery wages expense. So our entry should be debit salaries, sales rather, sales and delivery wages expense. Then we credit sales and delivery wages payable or accrued salaries and wages. Accrued sales, sorry, I need to correct that one. It should be accrued sales and delivery wages, 800. Okay, so take note ha. Sales and delivery wages payable or accrued sales and delivery wages payable, 800. Okay, so those are the adjusting entry for Quesada's laundry and dry cleaning business at the end of the year. Okay, so I'm done with that one. Then I will proceed to correction of errors. So what are correction of errors? These are mistakes in financial statement recognition, measurement, presentation, or disclosure caused by mathematical errors, accounting standard errors, or oversight of information that existed when preparing the financial statement. Uh, and also, this may not be avoided, no? Then the correction of errors in previously issued financial statement is known as an error correction. Okay, so I have here some illustration for correction of errors. So we'll take the first one. A collection of accounts receivable amounting to 100,000 was recorded as 10,000. Okay, what I will do is that I will be presenting to you the wrong entry committed, and then also I will be showing you the should be entry, or this is the correct entry, so that we would be able to compare the wrong entry made and the should be entry so that we can properly make the correcting entry. Okay, so what is the error here? Okay, a collection of accounts receivable amounting to 100,000 was recorded as 10,000. So this is the wrong entry. Debit to cash 10,000, then a credit to accounts receivable 100,000. And the should be entry or the correct entry should be this one. A debit to cash 100,000 and a credit to accounts receivable 100,000. So from here, you can now determine what should be the correcting entry. If you notice, we have the same accounts debited and account credited now. The only difference is that the amount. Okay, so we have the correct amount debited and the correct account, the correct account credited and the correct account debited. So the problem lang is the figures. So it is understated. So instead of 100,000, it was debited to 10,000. So we'll just add. Okay. So to correct, we just debit cash 90,000, difference between 100,000 and 10,000, and a credit to accounts receivable 90,000. Okay, then we have number 2, salaries expense of 10,000 was debited to rent expense of 10,000. Okay, so this is the wrong entry for number 2. Rent expense 10,000, then credit to cash 10,000. Then there should be entry, since that is a salaries expense, no? So your entry should be debit salaries expense 10,000, credit cash 10,000. Now, what's the difference? Actually, they differ on the account title. They have the same amount. So the error here is that it was charged to a wrong account. So what you will do, just debit the correct amount and close the wrong account. Okay, so that's why we debit salaries expense. This is the correct one. And close rent expense. So since it's debited, to close it, we credit it 10,000. Okay, so again, your correcting entry is debit salaries expense 10,000 and credit rent expense 10,000. Number 3, payment to accounts payable was debited to purchase 200,000. This is a payment to AP. So this is the wrong entry. Debit purchases 200,000 and credit cash 200,000. The correct amount should be a debit to accounts payable since it's a payment of account. This is a debit to accounts payable 200,000 and a credit to cash 200,000. Now, if you're going to compare, we have the same credit. The problem is that we have debited the wrong account. So what you will do is debit to correct is debit the right account. So debit accounts payable 200,000 and close purchases 200,000. So debit na siya to close credit. So credit purchases 200,000. Okay, so this is the correcting entry. Number 4, sales amounting to 300,000 was recorded for 30,000. So it's understated. No? So this is the wrong entry. Cash 30,000, credit sales 30,000. And should be entry, or the correct entry is a debit to cash 300,000 and a credit to sales 300,000. So to correct, just add an amount because this is understated by 270,000. So just add 270,000 because sakto naman ang cash debited, no? And also sales. So we just debit cash for additional 270,000 and a credit to sales for an additional of 270,000. Then number 5, accrued interest income for 20,000 was debited to accrued interest expense in the book. So this is the wrong entry. Debit accrued interest expense 20,000 and credit interest income 20,000. The correct entry should be accrued interest income 20,000 and credit interest income 20,000. So just compare. We have the same amount, so we have the correct amount, but the problem is we have the wrong debit. Okay, for the account, the account debited is an erroneous one, so it has to be this one, accrued interest income, not accrued interest expense. So what you will do is just debit the correct amount for 20,000, so debit accrued interest income, and then close accrued interest expense. This is an erroneous account. So close accrued interest expense for 20,000. Okay? So that's how you prepare or do correction of some errors, no, made in the book. Okay? So that's the end of my video discussion. So if you have some questions, you may just ask during our virtual session. Thank you.